It's Sunday, the 10th of January 2021. The gold market was pretty interesting this week, as were a few of the sort of macro markets, quite a few events happening. So I'm just going to do a brief update on that. This is a free video if you're watching it on YouTube. Most of my content now is on Patreon, where I run a small page there, a bit under 240 followers now, $6 a month it costs, and I just do a few videos each week talking about individual stocks and portfolio, what I'm doing with my own money, that sort of thing, and really trying to do some deep dives into some stocks as well, focusing a lot of quarterly reports. This month being the month after the end of a quarter, there's all the December quarterly reports that will be coming out in the next 2 weeks, 2 or 3 weeks on the ASX, predominantly ASX focused, but also doing a few of the TSX stocks now as well. So if that's something that might interest you, feel free to sign up to the page. The link will be in the comments. So as I was saying, the gold market really strong this week initially, and then closed down strongly on Friday, about 3% down. And I thought it felt like there was sort of this, it felt like we could have a pretty strong move to the start of the week. The sentiment, I think, in the gold market looked pretty bullish. And I think some of the stuff politically, what was happening in America with the Senate runoff elections in Georgia, and I'll just bring up the article there. You know, the Senate elections, it was never expected the Democrats were going to win both seats there, and it gradually, toward the end of last week, a few things sort of evolved, and it looked like maybe their chances of winning those seats were higher. And then that actually happened on Tuesday in America, that the Democrats won both those seats. So now they have control of the Senate, or the majority with Kamala Harris's vote. So that means they can really sort of get more of their legislative agenda through, which is largely seen to be, I think, before the US election in November, a blue wave, or a blue sweep, a Democrat sweep of all the houses in the presidency was seen as very positive for gold. More stimulus, likely more stimulus. To go with a very accommodative monetary policy, and that I think still remains. So it was funny, I think we saw that sort of, perhaps that was part of the move on Monday, this sort of buy the rumor type thing of this Georgia runoff, the Democrats kind of winning there, and then when it happened, we have the big sell down, and that was kind of unexpected, I guess, on Friday to see that, and it was all even more unexpected with the jobs report that came out on Friday was incredibly weak. Below the weakest of estimates, I think, and the economy lost 140,000 jobs in December, and I think the mean estimate was kind of a 50,000 gain or something like that. So it was a lot worse than expected, and it shows sort of how their economy is faltering, and all of the stuff that Biden said is continued to indicate that they're going to be trying to do more stimulus, this $2,000 checks and this sort of stuff. I think that's more likely to happen now with the Republicans not being able to kind of stop it as much. And that resistance seemed to be gradually dying as well. So I guess my point is, I think the broad picture for gold remains the same, but there's definitely short-term technical weakness caused by this massive sort of sell-off. But it's not the first time we've seen this 1950 level being the breakdown level 3 times now since September. You see we had the 3 down days there, another big down day in November around the same level, and right down to this 1850, which I think in the last video I did on the general sort of gold market, probably 3 or 4 weeks ago, I talked about that 1850 as a key level. If we could break back above it, that would seem in a more positive, the gold market looked more positive. And we did, and that's when the sentiment started to come off. And I think with this new year, people start to look at, go back and look at how things are looking in terms of overall markets and where to position themselves. So then we see gold rallying strongly at the start of the year, and then the sell down. So I think we're going to need to see this 1850 hold again. If it does, it kind of looks like we potentially could be running towards sort of an inverse head and shoulders here, potentially around this 1850 is kind of the shoulders, and then the bottom, the head here. So inverse head and shoulders kind of is a breakout. The breakout level would appear to be this 1950. So if we break out above 1950, you're sort of looking at potentially a move up toward a $200 type move. So generally it's the height of the head. So 1770 to 1950 is kind of what's that, about $180. That would be your upside potential on a break of that 1950 sort of level. But it does look like short-term weakness. I think one of the things behind that, here's a chart. I think I've talked in the past about this relationship between gold and 10-year, or not 10-year, but just real rates in general. So the yield on the 5, 10, 3-year bond, or whichever one you want to use, and deducting inflation. And I think that's what really came off on Friday. So generally these two will move in step. This is almost a perfect correlation between these two instruments. So we saw the yields rise and on Friday, which is kind of a little bit strange. And I think if that continues, if we continue to see yields rise, you could start to see asset prices sell off in general. You could start to see the S&P 500 roll over pretty quickly. So I guess my feeling is that the Fed will continue to step in here. They will continue to keep rates in check, but perhaps with even more accommodative policy and restrictive policy in terms of yield curve control and these sort of things. They'll just prevent 10-year rates above a certain level, and they'll let inflation run hot. I saw a couple of people say this week that inflation is that the Fed might raise interest rates by the end of this year to tame inflation. I don't see that. That's not what the Fed has said for many years. They've said that they're going to be they're happy to let inflation run a bit over 2% because it's run a bit under. So there's this idea of symmetrical inflation where they keep it on. It's been under 2%. It's been between 1 and 2, for example, for the years up to now. The last 5 years, for example, maybe we let it run above 2 and to 3 for the next 5 years to keep it, symmetrical around 2 over that 10-year period. The idea of this is a bit silly because it sort of implies that they can control it on the upside as well, which has historically not been the case. When it gets out of control, once it gets above a level, they won't be able to keep it under control, and then it'll get higher. So I guess in general, I don't see anything's really changed here. This short-term move, if the markets start to sell off, if we see a big sell-off in the S&P 500, for example, will the Fed step in? I think the answer is unequivocally yes, in my view. They've really shown they're going to do that at a next level now. So if we start to see rates rise, if we see 10-year rates rise, and that causes a mini sell-off in the market of whatever 10, 15, 20%, we're going to see the Fed step in here quickly, and we're going to see, and that should be supportive for gold again. So I struggle with this idea that they're going to raise interest rates because inflation's running hot, and we saw this in the period a lot before 2016, where they said they were going to raise interest rates. They never really could. And this went on for years, and then they did it once or twice, and then they had a bigger period of raising rates after that. But I think they're not going to be raising rates for a long time, and that's what they've said. So I don't really understand why people are kind of second guessing their actions over the last 12 years since the financial crisis and thinking they're going to change, and they are going against what they've actually said, that they're not going to let rates rise and they're going to let inflation run hot. Anyway, that's kind of the broad economics sort of discussion, but I just really think that the narrative hasn't changed for gold. So I continue to be a buyer of predominantly mid-cap and large cap stocks at the moment, and a few juniors as well. But in any case, I think this 1850 has to hold. Otherwise, we're probably looking down first to 1820, and then you've probably got the target, the previous low in December or late November there around 1770, as well as the next potential level. So that's the sort of, I'm not diving in too much into some of the gold stocks at the moment, but I thought one thing that was interesting on Friday and last week in general was the action in the gold miners seemed pretty bullish. You see there quite a large volume of coming in on Monday, largest volume day we'd had there in a couple of months, in a period of pretty weak volume generally, the start of January. And then even on Friday with the gold price selling off by that sort of 3.5%, The miners showed a bit of strength, and I think outperformance. I think the GDX fell about 4%, or was that 4.8? For a gold move of 3.5 down, I would be expecting the GDX to be down 7-8% probably. So, and you got that long tail there. So there's a little bit of strength there, and you can see. I mean, this chart to me looks nigh on perfect when I look at it. How it's consolidated in the last few months, trying to break above this trend, keeps getting knocked back, but it looks like there's real strength here, and we're still. I think it's important to keep looking at that. Just trying to zoom out a bit, that long-term chart of how we've progressed here. The nice move since March, and then this 4 or 5 months sort of fairly controlled descent, and then it looks like it wants to break higher to me from this move. But so and these companies, these mid-large cap gold miners, are just printing money at these gold prices, even if the price of gold was to go to 1,700, for example. I think these companies are severely undervalued, just on a cash flow and earnings, and dividends in some cases as well. So that's where I'm sort of putting more of my money at the moment. But I think that chart looks very good. And I thought, as I said, I thought that outperformance was a little bit interesting this week in the miners. Not something I've seen for a while. So maybe that story of gold miners being a pretty good sector to be in is starting to be picked up by some of the mainstream as well. So that was one thing as I was looking at. As I said, I think the S&P 500 is still just melting up, this same old trend. But you wonder, as I said, if we see 10-year rates rise or any of the interest rates rise, that can't be good for asset markets that are just supremely overvalued, in almost every sense. Bonds, stocks, in macro sense, stocks are overvalued massively. And of course we've had, probably can't do a video without talking about Tesla and Bitcoin, as well as the other sort of archetypal bubbles of this period. Tesla stock up. How far did it go up this week? Even it's gone up from about 20% up in a week, or more than 20% up this week. We're clearly reaching, I think, the peak of this bubble, that with this pops within the next week, maybe 2 weeks tops, but I think in the next week this bubble starts to pop. That doesn't mean it goes down 80% in a week, but I think we're near on the end of this. And I was looking back at a few historic bubbles in history this week, and sort of thinking about there's a sort of a correlation here in terms of this time period around the start of the turn of a year. Late December, early January often is a period where bubbles tend to peak. And my thinking there is that kind of, and I tweeted about this, I think that probably there's a lot more chatter around friends and family and information transfer around this time of year. And also we start to see this sort of New Year's resolution type stuff, and people's thoughts about how things are going to change in their portfolios throughout a year at the turn of the year, and how to rebalance them. And it just happens that gold peaked in January 1980, for example, when that bubble peaked. Not saying gold's in a bubble now, far from it, but it was then. And Tesla, I think, will be, and I've thought this for a long time, that when the markets start to fall, and in 20 years people are going to look back at Tesla, and this will be the stock that is remembered as the peak of insanity, how it moved up. And Bitcoin potentially as well. Bitcoin 2017 peaked around mid to late December as well. So I think, and then I was looking at the Nikkei as well. The Japanese bubble in the late 1980s is famed, and that peaked late December. I think December 29th, 1989. The Nikkei burst, and we saw down down about 30% within 4 months. And that was an unstoppable market, probably a bigger bubble than we have now, even in the S&P 500. This is, in general, my thinking is that stocks are incredibly overvalued, and that the sort of euphoric environment we're in now cannot last much longer. I've been saying that for a while, but I think we really are seeing signs of it reaching toward the end, as some of these as stocks like Tesla start to roll over. I think we start to see that pretty soon. And there's still no acknowledgement that this is going to happen. And it's pretty strange to me, even with the events of last year, that with stocks falling, what is it, almost 40%, probably 3,300 down to say 33% from in that March period. That there's sort of still no acknowledgement that this can happen again, which is, it seems like the markets are even more fragile and the economy is even more fragile. The only thing still there is the Fed, and you sort of wonder how much the Fed can still keep this idea alive, of everyone putting their money into the market. But I'll stay. I don't have my short position in the S&P 500 anymore, and I'm still waiting for that to burst. But it's a hard thing to do. But clearly, there's insanity in a lot of these stocks, and it's not a time to be. I don't think it's a time to be aggressive in this market. It just looks, a lot of these stocks look incredibly overvalued, and you sort of wonder what can make it pop. Does it need something? But then the question is, does it need something to pop? Can it just roll over just with more sellers? One day we might just start seeing more sellers come into the market, and then it just gets momentum of its own, even with accommodative policy. I think the Australian dollar, again, I think it's really still rising on that same risk on trade that we've had for a while, and US dollar weakness. Did start to see it, starting to see the little bit of US dollar strength, probably related to also that rising yields. But in general, I think we're just seeing the Australian dollar following that trend of risk on, as it tends to do. But I'm not. I've sort of been. Initially, after I think a lot of people in the March and April downturn, I guess, thought that it was probably best time to be out of Australian dollars, that you might see risk off. We're going to see US dollar strength. Not a good time to be in Australian dollars, but I sort of worked out eventually that was probably the wrong trade. Where if you want to beat the US dollar at a game of the US Treasury and Fed at a game of devaluation, they're usually going to win that game. And they have, I think I exited my Australian dollar short probably around 70, 71, I think. And that seems to be the right move. And at the same time, I've moved out of a lot of those Australian gold miners, companies like Regis or even Saracen. These stocks have probably been some of the weaker gold stocks in the GDX in the last 6 months. So I sort of got out of a lot of the Australian gold miners. Probably in this June, July period, I thought they were getting a bit overvalued. And then just in the last 6 weeks, I started buying them again. Not Saracen, but companies like Regis, that had been sold off heavily. I just started buying that back in November. So this is the sort of stuff I talk about in the weekly videos as well, and portfolio stuff. So that's probably all I really have to say. I just wanted to do a brief video about the markets, trying to sort of look at a few things this weekend and trying to understand what this means for the gold market. A lot of this, talk of higher rates and all this sort of stuff and inflation. And as I said, I don't think the story's really changed. And I think still, to me, it looks fairly positive, but it is a time to be sort of looking at, I guess, the short-term technicals and some of that. If these levels are broken, obviously the miners are going to struggle to move up, even if they are fundamentally undervalued. But I think that main thing I was focusing on is that relative strength of the mining stocks compared to what they have been in the past, and I think that's a positive sign, because I don't own gold, physical gold or futures or any gold instrument. I own mining stocks, so that's what I'm predominantly interested in. But I obviously track the gold price as well. But so that outperformance was of interest to me. So hopefully you got something out of that, and I'll see you in another video. Thanks very much.